the only thing I would say is that if this chap has gone short, then he's got to bite back. And then what price? There's no physical around at all. Meaningfully. I mean, the only thing you can do is rush out, buy futures and stand for delivery, or go into London and buy a forward contract and insist on delivery. There isn't any meaningful quantities of silver around. So if you get someone chucking out billions in paper, I mean, it's just going to lead to a squeeze later, because there is not. I mean, if you're going to go short of something like that, then it only works if there are an awful lot of people long and you can shake the trees and get these punters out and force them to close. That's the only way in which a short really works. I mean, unless you're talking about investing in a company which goes bust. You got some inside information. That's not what we're talking about. We're talking about a situation that requires people on the other side of the transaction to sell after you so that you can retrieve your position. And if you're going to go and sell a huge quantity of futures or sell forward, huge amounts, whatever, then in the absence of that cover, you're going to get squeezed on the way out. And this chap, apparently, he made a fortune or something in gold. I must admit, I haven't really got to grips with the story, but
he made about $3 billion in betting long on gold since 2022.
Well done him. Yeah. I mean, if he's gone and shorted silver, I think what I would say is that his long position in gold was either on the back of information from, let us say, the highest contacts in government in China. There's no doubt that China has been a major force in driving the value of gold. Or alternatively, he just got lucky. It happens. It does happen. But you know what trading is like? You trade, you think, oh, God, aren't I clever? I've made a fortune, done very well. I can't lose. I know what I'm doing. So you go and make another bet, and then what happens? You get killed. That's the way trading works for most of us anyway. So I'm not impressed. And I would say that, what I do know is that the people who are trying to stack silver in size, there's none available. And you go to the refineries, and they say, sorry, we haven't got any. We're too busy doing gold. If you want gold, go and join the queue. You could probably get some gold, but silver, forget it. That's just, there's none, full stop.
Yeah, and silver is currently trading at $75 spot. Good luck trying to get $75 spot anywhere. Trying to find $75 spot at any dealership or from anyone at this point. Yeah. So you're going to be looking at premiums, massive premiums.
Yeah. It's fascinating. If you look at the open interest on COMEX in silver, it's pretty low, which confirms that the punters are just not in it, And I think this shakeout that we've had really from the end of the February contract, really the consequence is that there is a platform, I think, for the silver price to go considerably higher than it might have done otherwise on this run. It looks good to me. But of course, you've got to have a bit of nerves because it's quite volatile. But there we are. This is why I always tell people, for goodness sake, don't try and double guess it, because there are people in there far larger than you who will whipsaw you. Thing to do is just stack. Don't worry. Just stack and don't worry. And you could have been stacking silver for years, but eventually the whole thing came right. And it looks to me as if it'll continue to come right, because assuming gold goes higher, and that's another story which I'm sure we will talk about, then, silver, I think, or next, I don't know if this is true, but Vance is calling a meeting of 50 nations to try and set a floor on the price of critical minerals. It didn't make much sense to me, quite frankly. You set a floor on the price. So what do? You say it's bid only here. I mean, it's just complete nonsense. The report was nonsense. I don't know what Vance was actually doing, if he was doing anything. But there's no doubt about it. We're talking about a problem which America, I'm sure, is considering how to fix it. But it's going to take time. I mean, you can't suddenly set up a refinery for stuff in volume. It is going to take time. So, but what we're talking about is a squeeze in the market, which is now. And we're talking about the demise of the paper currency system, as the means of controlling the value of physical. That, I think, is coming to an end. And if I'm right in that, then you're talking about at most a year, probably months, before the sort of derivative situation, if you like, suddenly either implodes or goes away, open interest goes down towards zero, whatever, however you like to put it. But I mean, we've lost control of the prices here completely. And using futures and forwards as a means of controlling prices, that's yesterday's story now. Price control for silver is actually in China's hands now. And they seem to be quite happy to see the price rise. It would be quite easy for China to turn around and say, right, we're going to stuff some silver into the SGE vaults and make it all look nice, tickety-boo, take the steam out of it and all the rest of it. They show no signs of doing it, which I think gives us a message as well. It raises the question, what is China's official policy on silver? We know that they came in with new regulations, export controls. They allow something like 40 organizations to export silver. But basically, behind that, there is, if you like, the intent to have a firmer control over the export of silver from China. All this is designed, I think, to put the squeeze on someone, us, I don't know, America, President Trump. They have it within their power, actually, to flood the market with silver, but they're not doing it.
Why do you think they haven't? It's because you think they're purposely trying to up the price of silver?
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for Capital Cause and viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020.
I think they recognize that there is a big change. And, this is what's led me to speculate that they will probably, they're probably considering putting the domestic yuan onto a silver standard, because after all, that's where it was. Last time there was a metallic standard. And they've got the means to do it. But what they've got to see, I think, is not just the yuan gold exchange rate rise measured in yuan, but they will also need to see the exchange rate between gold and silver rise to the point where it becomes practicable. So, I don't know. I mean, if I'm right about that, and I've got no evidence that I am right, I'm just purely speculating, then China would probably, sort of reckon that the gold-silver ratio should be in the region of 15. That's where it was before.
15.
I don't know. And you see, you've also got the same situation in India. India is actually...
In the overall market, we're looking at the markets today. All the market indices are down, but most notably, Bitcoin is just taking a beating. And now, I know you don't cover Bitcoin that often, but isn't Bitcoin kind of a proxy for the growth sector in this case? The Bitcoin and the Nasdaq have been fairly correlated for a number of years now. So, is the fact that I'm looking at a 6% drop in Bitcoin right now. It's below 70,000 at 68,000 at the time of this recording. Is this an omen as to what's coming soon for the Nasdaq and the overall broad market?
Nasdaq is in a credit bubble, and Bitcoin is in a super credit bubble. That's why they correlate. It's valueless. There's no value to it. It's not money in any legal definition. It's hardly likely to ever become money in a meaningful sense for anyone who wants to use it to settle transactions, and it's not credit either. So it's a nothing. It's I saw there was a posting on X where some poor chap got completely wiped out in Bitcoin. I'm afraid there are going to be more of them who are going to get completely wiped out, and I think that's very sad.
Are you referring to Michael Saylor? Are you referring to Michael Saylor in this case?
No, I wasn't specifically referring to him. I mean, he's got quite enough troubles, and he's struggling. He's trying very, very hard to talk it up and all the rest of it. I wouldn't like to be in his position, I must admit. But I'm not sitting on the sidelines and crowing at his misfortune. I mean, I don't like the way he's promoted Bitcoin. I think it was dishonest. I think it is horrid. But nonetheless, we're watching someone who's just getting absolutely injecting liquidity into the system, which is a separate thing, which is done by QE. And I think what you're likely to see is that bond yields will, particularly at the long end, will start rising again. And once they break out above roughly the 4 point, if you look at the 10-year above the 4.755 level, those yields will go a lot higher, and that will crash the equity market. Equity market crashes. What then does the Fed and the US Treasury do? Well, it's a rescue operation from there. And you'll see QE like you've never seen before. And what it'll do to the value of the dollar? Well, the dollar will crash. And that actually, I think, partly is why gold was being so strong up until last week, because the serious money around the world has just been getting the hell out of the dollar. And I understand that even on this crash, they're saying, give me more. They're buying gold. They're trying to get as much gold as they can get, which is interesting because, you're not going to see, you may see the paper dollar of gold move here, there, anywhere. But the one thing that's not going to happen is you're not going to see any physical gold coming out. It'll all be absorbed, and there are buyers queuing up for it. It really is like that. And I understand also that the Swiss refiners are only doing kilo bars, and I don't know whether they're doing LBMA bars, but the smaller stuff, they can't touch it because, the pressure to refine is so great on them. They're not doing small units.
Yeah, and it's also interesting with this bloodbath in metals the last week or so. Silver seems to have found some support at $70.
Yeah,
gold seems to have found support around $4,500, and Friday was really an outlier of a day. This was the biggest price crash in silver history. I think it was like the sixth biggest in gold history, but nonetheless, the momentum was not strong enough to break through either of those support lines or barriers, so to speak. What does that imply to you?
Well, I think you have to look at it in the context of the timing of it. By Friday evening, in China's time, if you like. Everybody had gone home. They closed. They had actually started closing a few positions ahead of the weekend, which any speculator is sensible to do. And that then left the market, if you like, in the hands of London and also COMEX. And basically, once they managed to start shifting the price downwards, there were no buyers. It was an offered-only market. So you had a vacuum under the price, and they could push it to anywhere they wanted. And all this was facilitated by China's absence over the week, with their weekend starting early, and at the same time, the end of the February contract. So that was the basis of it. And that's why it was so violent. I mean, something which we'd normally expect to take a month or two just literally happened in a day. And of course, it sort of discombobulates everybody so that on Monday, you don't know what the hell's going to happen. It sort of went up, went down, we saw a new low, and people were sort of holding their, the traders were sort of worried. But I mean, the fact is that traders are not in there. Just look at the open interest. And the open interest in gold has just completely collapsed. It's just over 400,000 contracts now. That by any definition is oversold. And the interesting thing is, if you looked at the commitment of traders figures between, I think it was the 2nd of December and
The conversation you just watched captures something far bigger than a volatile week in silver. What Alasdair Macleod is describing isn't simply a speculative squeeze or a billionaire's bold trade gone wrong. It's the slow tectonic shift of monetary power from west to east. And silver is sitting right at the fault line. Let's start with the physical market. When refiners are telling large buyers there is no meaningful silver available, that's not retail hype. Silver is primarily a byproduct metal. Roughly 70% of global silver supply comes from mining copper, lead, zinc, and gold. That means silver output is not driven by silver prices. It is driven by industrial base metal demand. If global growth slows or base metal mining tightens, silver supply doesn't automatically rise even if price explodes. This structural constraint is underappreciated. Meanwhile, industrial demand has never been stronger. Solar photovoltaic manufacturing is consuming record quantities of silver. Despite technological thrifting, total demand keeps rising because installations are scaling faster than per-panel usage is falling. Electric vehicles use significantly more silver than combustion vehicles due to power electronics, battery management systems, and advanced circuitry. AI data centers, 5G infrastructure, military electronics. They all require high conductivity materials. Silver remains unmatched in electrical conductivity. There is no substitute that performs as well at scale. Now place that industrial reality inside China's supply chain dominance. China refines the majority of the world's silver. It imports concentrate from Latin America and Africa, extracts the silver content domestically, and controls the export channels. That alone gives Beijing leverage. But the more subtle point Macleod raises is cultural and monetary. Asia remembers silver as money. China operated on a silver standard until 1935. India still hoards silver in enormous quantities at the household level. In much of the developing world, silver is not small change. It is stored wealth. When China tightens export oversight and allows only select institutions to ship silver abroad, that is not random bureaucracy. It signals resource nationalism. We have already seen this playbook with rare earths, gallium, and germanium. Strategic materials are being treated as geopolitical assets. If silver becomes formally recognized as a critical mineral in Western industrial policy, and it increasingly is, then we are looking at a resource competition, not a simple commodity cycle. The idea of a domestic silver-linked monetary mechanism in China may sound speculative, but it's not irrational. China has accumulated substantial gold reserves and continues to import aggressively through Hong Kong and Shanghai. If the yuan were partially anchored to gold for international trade settlement while maintaining tighter domestic controls, a parallel internal silver mechanism would not be unprecedented in monetary history. Historically, gold and silver operated in tandem systems for centuries. A fixed gold-silver ratio of 15:1, as Macleod mentioned, would imply a radically higher silver price relative to today's market ratio, which has floated near 80:1 or higher in recent years. Even if no formal silver standard emerges, the practical effect may look similar. If Chinese households increasingly allocate savings into gold accumulation programs, and potentially silver, that redirects trillions of yuan away from property speculation and into hard assets. China's household savings rate remains extraordinarily high by global standards. Even a small allocation shift into bullion markets creates outsized demand pressure in a relatively small physical silver market. Contrast that with the Western paper market structure. COMEX open interest collapsing while price volatility spikes is a warning sign. It suggests futures traders are stepping back. The more paper leverage leaves the system, the more price discovery shifts toward physical settlement. Historically, commodity markets dominated by derivatives can suppress price signals until they can't. When physical delivery demand overwhelms paper supply, volatility accelerates upward, not downward. Then there is the macro overlay. Japan's bond market stress is not a side story. Japan has been one of the largest foreign holders of U.S. treasuries. If yen carry trades unwind and Japanese institutions repatriate capital, U.S. bond yields rise. Rising yields pressure equities. Equity stress pressures the Federal Reserve. And when the Fed responds, as it historically does, with liquidity injections, precious metals benefit. The relationship between expanding central bank balance sheets and gold performance is well established. Silver, with its higher volatility beta to gold, typically amplifies that move. Bitcoin's sharp decline in the interview period underscores the difference between liquidity-driven assets and monetary metals. Crypto trades as a risk asset in credit cycles. Silver and gold trade as counterparty risk hedges when monetary trust erodes. That divergence becomes critical during systemic stress. Let's also talk about the dollar. The U.S. fiscal position is deteriorating. Interest expense on federal debt has surged as rates rose. Treasury issuance remains heavy. If foreign buyers become less enthusiastic, and the Fed eventually resumes quantitative easing to stabilize markets, dollar purchasing power comes under pressure. Precious metals historically respond to real interest rate suppression and currency debasement. Silver, being smaller and thinner than gold, often reacts violently when monetary confidence weakens. Importantly, silver is not purely a monetary metal. That dual identity, monetary and industrial, creates asymmetry. In a recession, industrial demand may soften, but monetary demand typically rises. In inflationary growth, industrial demand surges while monetary hedging persists. Either path can support the metal, albeit through different channels. From a pro-precious metals perspective, the key takeaway is not daily volatility. It is structural imbalance. Physical supply is constrained by byproduct mining. Refining capacity is concentrated in China. Industrial demand is secular and technology-driven. Monetary policy globally remains unstable. Sovereign debt burdens are rising. Geopolitical fragmentation is accelerating resource nationalism. None of that guarantees a straight-line price increase. Silver is notoriously volatile. It overshoots both directions. But volatility is not weakness. It is a characteristic of a small market colliding with macro forces. The 1970s taught us that when monetary systems shift, silver can move multiples higher in compressed time frames. The 2011 spike reminded markets that speculative momentum layered on physical tightness can produce extraordinary runs. The bigger question is strategic positioning. Traders attempt to time swings and often get shaken out. Stackers, those allocating steadily regardless of price, treat silver as insurance against monetary disorder. If central banks globally are diversifying away from the dollar, if Eastern economies are reinforcing bullion accumulation, and if industrial electrification continues to expand, silver sits at the intersection of these forces. Alasdair Macleod's central thesis is that paper pricing power is weakening. Whether one agrees with every detail or not, the broader trend is visible. More countries questioning dollar dominance, more capital flowing into physical gold, more scrutiny on supply chains for critical minerals. Silver is both critical mineral and historical money. That duality may define its next decade. In the end, this is not about a Chinese billionaire's short position. It is about who controls physical metal, who controls refining, and who controls the narrative of monetary trust. As financial systems strain under debt and liquidity cycles grow more extreme, hard assets regain relevance. Silver, long dismissed as gold's volatile cousin, may be re-entering its historical role, not just as an industrial input, but as a monetary signal flare in a changing world.